Good morning, everyone, and welcome to JRG Advisors webinar for December 15th, which our topic today is compliance. Check your list and check it twice. I'm Frances Horn, and I'm your presenter for today. And before we get started, let's do some housekeeping. The presentation and copies of any questions and answers that will be provided will be provided to you via email after the webinar, probably within a day or two. And then also, if you have any questions, please feel free to go ahead and key them into the questions box, and then we'll address them at the end of the presentation. So with that, let's get started. And before we get into the actual substantive information, we want to go ahead and thank all of our valued partners and clients for participating in today's webinar. We really do appreciate you taking time out of your busy day, especially at this time of year, to participate. So let's look at our agenda. You know, it's that time of year where we have special checklists for everything. Okay, who are we going to buy gifts for? When do I have to get this in the mail? When do I pick this up? And it's the same thing with our employee benefit plans. We need to have a checklist to see if we have done everything we need to do in the past year and really start preparing us for what we do to do in the next. So some of the things we're going to be looking at today is reviewing that plan document, tax favored arrangements, the good old Affordable Care Act, the employer mandate, information reporting, and then the always other issues to check. So the first thing on our checklist is plan document review. Now we know that ERISA tells us that every welfare plan not only has to be established in writing, but more importantly, it has to be maintained in writing. And what that language means is the writing that is required, that plan document, and then a summary plan description, referred to as the SPD, that we need to go ahead and look at it to make sure that if there have been any changes, we've updated those documents along the lines. Now, we always talk about the ERISA plan document, and we know that if there are any governmental employers or church plan employers on the plan, you're not subject to ERISA, but it's always a best business practice still to have plan documents. Now, the plan document SPD, these are considered disclosure documents. And by disclosure documents, we mean they have to be made available to participants at certain times of the year or actually provided to plan participants at certain times. Now, as I noted, the documents need to be maintained. So just like anything else we maintain, we look to see, has there been changes? And if there have been, did we amend our document? Did we send out something called a summary material modifications? The information in the plan document, SPD, is considered the terms of the plan. And any time those terms are changed, either one or two things have to happen. Either an updated SPD has to be provided, or what's known as that SMM, a summary material modification, must be given to participants, and they should be advised to keep that document with their old SPD. Now, SMMs are provided on a different time frame depending on whether the change is a material reduction in benefits or not. If it's a material reduction in benefits, the SMM has to be provided within 60 days. If it's just a regular change, then it has to be provided 210 days after the end of the plan year. So knowing the terms of the plan is extremely important, since the main fiduciary duty of an employer as the plan sponsor is to govern the plan according to its terms. So let's go ahead and let's look at some terms that should be in our documents. Some are very basic, but some can also be very specific and somewhat a little bit complicated. Now, we haven't outlined everything here, but we've tried to put the most important things. And the first thing that we really should have is that every plan has to have a named fiduciary, someone who's going to be responsible, again, for governing that plan. Some of the other things, the plan identifying information. What's the name? So when we talk about name, we mean the name of the plan. Is it ABC Group Health Plan? ABC Employee Benefit Plan, something that you've named it. Plan sponsor, who is generally the employer, address, the employer EIN, the type of plan. Is it a welfare plan? Is it a health plan? Administration. Do we use a carrier to help us, or do we use a TPA for a self-insured? And then most importantly, that plan year. When do the benefits start for employees? January 1st. Maybe our plan starts March 1st. But we need to have that 12-month period known as the plan year. Next important information, eligibility information. How do you define an employee, or who's eligible to be in the plan? Is it anyone who works for you? Is it a full-time employee, a part-time employee? Have the requirements to work a certain number of hours changed? Especially if you're a large employer subject to the Affordable Care Act, your definition of full-time employee for health care may now be 30 hours instead of 40 hours a week. What about how does the plan interact or connect with family medical leave, other leaves, especially workers' compensation? In all of my years of experience, I think the biggest I get as to employees being eligible on the plan relate to, geez, they've been on workers' compensation. Can I terminate them from the coverage? Then we have to have that description of benefits. What's included? What isn't? Do we have dental and vision? Do we have any kind of disability? Only medical coverage. Loss of benefits. What kind of causes do we have for termination? If an employee doesn't provide you his or her share of the premium, can you terminate him from the plan? What does your plan say? Funding. Are you fully insured or self-insured? And do you have employee contributions, pre-tax or post-tax? I want to just briefly mention self-insured for last minute, because in our last presentation, we got a great question. Someone said, how do I know if I'm self-insured? You can tell you're self-insured because you generally will not have a contract with an insurance carrier, such as Highmark or Aetna or United Healthcare, or with one of your disability carriers. If you're paying for those benefits for an employee out of what's called the general assets of an employer, then you're self-insured. Another term of the plan, claims. When can they be denied? If they are denied, do I have a right to go ahead and say I want it to be appealed? Some other things, real important. Who can amend this plan? Also something called QMSCO, Qualified Medical Child Support Order Procedures. And then we have this tagline down here, watch for the changes to the Affordable Care Act. So as we start our checklist, let's look at some of the things as to that plan document. Did you make changes to copays, co-insurance, or deductibles, or employee contributions during the past year for your plan? What about those eligibility requirements we talked about? Because of the Affordable Care Act, did you change it from someone having to work 40 hours to 30 hours? Have you ensured your waiting period doesn't exceed 90 days? And that there are no limits to essential health benefits? Something we need to be sure of also now is this annual out-of-pocket. There is a certain limitation, and we have the dollar amount for 2016, but our plan cannot exceed that amount. What about grandfather status? I know there aren't a lot of grandfather plans still out there, but remember, if you made changes to copays or deductibles, you may have lost that grandfather status or grandmother status. A lot of employers looked at their plan and decided to go ahead and move from what's called the grandmother plan into what's called an Affordable Care Act compliant plan. So when we talk about all these changes, did you provide that SMM when these changes were made, or do you still need to do that? So moving on, we're going to talk about tax-favored arrangements for a couple minutes. Now, under our tax code, it says, income is income from whatever source derived, unless there is an exception provided in the Internal Revenue Code. So what that means, any time that we receive anything of value, we should be taxed on it. So technically, benefits that either we receive as an employee or that are provided to our employees as an employer really should be taxable income. Now, don't everyone get in a panic here, because what I've said is pretty strong, but however, we know that there is an exception to this taxable requirement under several sections in the Internal Revenue Code. The main sections are sections 104, 105, and 106. And these are because these are exceptions when benefits are paid for medical care, hospitalization, sickness, disability, certain time off required for work. And that is why we call the employee benefits tax favored, because they receive something and they don't have to pay taxes on it. Now, under the Affordable Care Act, we're told that our group health plans must provide certain benefits under the market reforms, or the plans could be penalized or taxed. And specifically, we know that we have to provide cost-free preventive services and that there can be no annual or lifetime limits on what's called essential health benefits. Now, in 2013, the IRS gave us some new rules on certain benefits and conditions that have to be met. And they also continue to remind us that if they aren't met, the violations could cost $100 per day. But they're specifically about certain benefit programs that we're very familiar with. And the first is what's known as a health reimbursement arrangement, referenced as an HRA. We've been told that an HRA can no longer be what's called standalone. It has to be integrated with another major medical coverage or major medical plan. We have one limited exception to that. If you have a retiree HRA, it can be standalone. So by standalone, I mean you just don't say, we're establishing an HRA and we're going to put money in it, and if you need to have medical expenses reimbursed, we'll pay for it. There's no connection to a group health plan in that instance, and again, it's no longer acceptable. The other thing we have to be concerned about as a group health plan is our health flexible spending accounts. We know that in order for them not to be subject to the Affordable Care Act, they have to be considered what's accepted. And accepted means that the benefit that is available to a participant does not exceed 2 times the employee or participant's salary reduction election, or if it's greater, $500 plus the employee salary reduction election. So in that instance, you have to be careful, because even as an employer, if you're putting money into an FSA for your employees, and if that employee doesn't elect anything, if what the employer puts in is more than $500, then you have removed your from the protection of that accepted benefit. So again, something to be very mindful of and watchful of. Also, cafeteria plans are tax-favored arrangements. We know that cafeteria plans are a vehicle so that our employees can pay for premiums for health care, dental, sometimes disability, even though that's not always recommended, but it's on a pre-tax basis. And just want to go ahead and put a plug in here. In February and March of next year, we're going to be doing 2 different webinars on cafeteria plans, and we're really going to go into the meat and potatoes of cafeteria plans. So you may want to put that on your schedule. But for right now, remember, cafeteria plans, they're tax-favored arrangements, which means that they have to meet the requirements under the set by the Internal Revenue Service. So let's quickly go over our checklist as it relates to tax-favored arrangements. Again, ensure that all your HRAs are integrated. No standalone HRAs. The penalties are really steep. It's $100 per day per affected individual. For a year, that would be $36,500. Ensure your HRA is only reimbursing allowable medical expenses. Remember, it cannot reimburse individual policy premiums, and those aren't any individual policy premiums. It also cannot reimburse any type of Medicare premiums, such as a Medigap policy or Part B or Part D, again. And there is a very limited exception that is set up there, but generally that's considered individual policy, cannot be reimbursed. We've just mentioned, keep that FSA as an accepted benefit. You don't want to be paying penalties on it. The Health FSA employee salary reduction for 2016 cannot exceed $2,550. That's the same amount as it was for 2015. However, the Internal Revenue Service did not change that amount. They did not index it. Under your Health FSA, you can either have a $500 carryover that's now permitted or a grace period. Be careful. Make sure you don't have both, because you're not permitted to have both. Your cafeteria plan, does it only permit, does not permit pre-tax payment of individual policies. It's just like the HRA, again, no longer considered because these individual policies don't meet the Affordable Care Act requirement when an employer pays for them. And then insurance cafeteria plans, you only permit reasons. You only permit employees to either change their elections or to drop their coverage under a cafeteria plan for those reasons that the IRS allows. So next on our checklist, and everyone has probably just had it up to their eyeballs on hearing about the employer mandate or the pay or play. However, it really is an important item on our checklist. A quick nutshell recap: large employers, 50 or more full-time equivalent employees. You have to offer minimum essential coverage, that's minimum value and affordable. If you don't do that and one of your full-time employees goes to the exchange and gets a subsidy, then you could possibly be subject to a penalty. We know there was transition relief for employers that have 50 to 99 employees in 2014, and they were required to meet certain conditions. And we've outlined those conditions in several other webinars that we've done. When we're looking at our employee count, always remember we have to consider any common control groups. So are we just a single employer, or are we part of a group that maybe the owner of our company has other companies out there? So again, you want to keep those things in mind. So our checklist, first of all, we want to go ahead and make sure that we've documented whether or not we are a large employer, and especially for the 2015 year. As a reminder, our status as a large employer is based on the previous year. So for 2015, we look back in 2014 to see if we had 50 or more full-time equivalent employees. And the same for 2016. You're going to look at your numbers for all of 2015 to see if you meet that 50 employee threshold or not. Did you take common control into consideration? You know, does the owner of your company have another, we gave example several weeks ago about maybe there's a bake shop over here, and maybe they own a tire shop somewhere, and everyone has to be combined together. And then what about those common controls? Common law employees, have they been counted? You need to be careful with that. So we're always talking about, the leased employee arrangement, the staffing employee arrangement, and it gets to be very convoluted. Have you ensured your coverage is minimum value? This is probably the easiest element that you have to meet. I think there's some kind of statistic out there that says 98% of employer plans meet minimum value. Remember, minimum value means it's a 60% actuarial or considered a bronze plan. Also, what about that affordability issue? Is the employee cost or employee share not exceeding 9.5% of their wages based on the safe harbors that the DOL's provided us? So let's look at this checklist for a minute. First of all, ensure a full-time employee is one who has on average 30 hours of service per week. It's no longer that 40 hours per week if you're that large employer, 50 or more full-time employees. And also, did you know what to count when we talk about hours of service? A lot of employers think, well, hours of service mean, Jim or Mary came in and worked 40 hours for me this week, so I gave them 40 hours based on, what they work, so that's more than 30. Hours of service, based on what the Department of Labor has told us, include any time that an employee is paid for performance of service or entitled to be paid when services are not performed. So let's briefly just talk about when services aren't performed. We have employees who go on vacation for a week or two, and when they come back, we still give them a paycheck. They didn't do any work during that 2 weeks they were off, but that's vacation time, so they were entitled to be paid for that. It's the same thing for sick time or any other kind of leave of absence that we may be paying the employee for. The one I really want to touch on, it talks about incapacity, including disability. And those are the words from the Department of Labor and the IRS. So when we're counting these hours of service that aren't performed, we may be looking when someone is out on a short-term disability or long-term disability based on our policy that we have. But also we have to consider workers' compensation. You know, they're paid, an employee is paid when they're out on workers' comp, so they're paid when services aren't being performed. You also need to take that into consideration when you're looking to see how many hours of service do they give us. And then we're told under the Affordable Care Act about this special unpaid leave. We have to count hours of service for some employees even when they don't get paid and they're out. And again, it's only based on federal leaves such as the Family Medical Leave Act, military leave, and jury duty. So let's get back to our checklist now. What about, have you established those monthly measurement periods, either monthly or a look-back measurement period for tracking to see if your employees are full-time or not? Did you set up that standard measurement period for your ongoing employees? And what about your new hire employees who are not considered full-time upon hire? Have you set up initial measurement periods for them? Something else that's important under the Affordable Care Act. If you are that large employer, the requirement is that you have to offer coverage to your full-time employees and their dependents. We're required to show that we offered them coverage, not necessarily paid for it, but that we offered them. And so the offer means that a participant or an employee has the affirmative ability to either accept or decline coverage. So do you have documentation to show which employees accepted or declined coverage? Do you have a waiver in place? And then finally, something that we don't have on our list but should have been included, did you remember to treat someone who may have terminated and returned within a 13-week period as what's called that continuing employee? Again, this is under the Affordable Care Act. So moving on, another ACA issue that we just want to plug our ears when we hear it mentioned. Again, a very important issue. And this is a reporting responsibility. And we've had several webinars on this also, so you may know this requirement as either the 6055, 6056 requirement. Some individuals call it the MEC reporting requirement and the ALE reporting requirement. So this is information, again, that you're going to be giving to the IRS and to individuals, letting them know the type and terms and conditions of health care coverage that you provided during the year. I know if you are that large employer that you're responsible for Forms 1095-C, which goes to the individual or employee, and 1094-C, which goes to the IRS. And ALE, if you're a large employer, you have to do this reporting regardless if you're fully insured or self-insured. We just, again, want to put this extra note in here about small employers under 50, but they may be self-insured. They're responsible for reporting on what's called the Form 1095-B and 1094-B. So let's look at the checklist for the information reporting. First of all, ensure your number of full-time equivalent employees in 2014 because, again, that drives your requirement in 2015. If you had 50 or more, then you're responsible for reporting as an ALE. If you had less than 50 and you're fully insured, hey, easy breezy, no reporting responsibility for you. However, if you have that less than 50 and self-insured, you are responsible for what's considered the MEC reporting. So let's just look for a minute at the 1095-C and all of the information that during the past year that you're going to have to report that you should have been collecting. You collect information for your employee, spouse, and dependent coverage, and it's always on a month-by-month basis because when you report on the 1095-C, it is broken down month by month. Names of employees, Social Security numbers, addresses, the coverage offered to them, again, month by month. That employee-only share of the lowest cost monthly premium, month by month. You need to be careful when you're looking at this reporting because, again, if your coverage or your policy or plan year starts other than January, for some months you may be reporting one premium And then for the rest of the year, you may have to report another premium because you had a change issued by the carrier. The name of covered individuals for those who have self-insured plans, and then covered individuals' Social Security number or date of birth if that Social Security number was not available. And again, that's for self-insured plans. We have a continuation of this checklist. You need to collect information, again, month-by-month basis for the 1094-C. Remember, the 1094-C is the document that goes to the IRS along with copies of your 1095-Cs. So you have to report the number of full-time employees month by month, number of total employees. Total employees includes full-time, part-time, if you call them seasonal, if you call them temporary, it's all of your employees. So just as another little tip, how do we determine our number of employees on a month-by-month basis? We have several ways that the DOL says we can look at it. We can either look at it based on the first day of the month or the last day of the month. Or we can look at it the first payroll period or the first day of the payroll period in the month or the last day of the first payroll period in the month. Also, they gave us another way to do it, and it's much easier. Look at the 12th day in the month, and then that's how you can determine your full-time employee count and your total employee count. You have to go ahead and report the months in which you met the requirement to offer minimum essential coverage. Again, if you are an applicable large employer. And then if you were in that 50 to 99 size group, remember, you still have to report, even though you didn't have to offer coverage, you have to report the months that you met that transition relief so that you don't have to do certain other reporting or offer of coverage. I keep mentioning this. Were you a member of a control group? Because you're going to report on your 1094-C if you were. You'll have to report the common control membership, meaning you're going to have to report on a month-by-month basis. Were you a member? And other members' names and EINs. So briefly, I gave an example, again, several weeks ago. I have 3 companies. So when I report for one company, I have to give the names and EINs of my other 2 companies. Finally, on our checklist, make sure that you're going to be able to meet the deadlines for filing the Form 1094-C and 1095-C. There are some really hefty fines out there if you don't meet the requirement. So the individual statements, the 1095-Cs, have to be provided to full-time employees by January 31st, 2016. As to the 1094-C, it has to be provided to the IRS by February 29th, 2016 if you're filing less than 250 Form 1094-5Cs. And if you're filing electronically, you have to provide that by March 31st, 2016 if you're filing over 250 1095-Cs, and you have to do that filing electronically. So again, a lot of information. We could be making this checklist go on and on and on, but we're going to be wrapping it up here in several minutes. So some other things that we needed to check. What about all of the notices that you were required to provide the plan participants during the year? HIPAA special enrollment rights, women's health and cancer rights, what we call the CHIPRA, Children's Health Insurance, newborns and mothers. What about that Medicare Part D notice of credible or non-credible coverage? Did you make sure that you gave it out in time? HIPAA notice of privacy practices. Now, what we have to be careful of, some of this information may already be in your benefit booklet, but if it isn't in the benefit booklet your carrier provides you, you as the employer and plan administrator are responsible for making sure plan participants know about all of these notices. So I always advise, as a best business practice, even though this may be in your benefit booklet, you should go ahead and include in the SPD that you provide or a standalone notices during your open enrollment period. COBRA general notice upon eligibility for group health plan coverage. Also, you have to remember, if you have an employee who enrolls in either family coverage or spousal coverage, The spouse has to also receive that general notice, so it generally has to be sent separate. Then we just include COBRA notices. Are you aware that there could be at least 6 COBRA notices that have to be sent? If someone doesn't pay their COBRA premium, are you sending, and you terminate them, are you sending out a notice of early termination of COBRA coverage? What if someone wants to be offered COBRA and you're saying, well, you're not eligible for that? Are you sending out that notice of unavailability of COBRA continuation coverage? So a lot more information that needs to be sent. And then finally, your summary of benefits and coverage. If you're fully insured, we know that the carrier provided that information to you. However, all of the carriers did not put all the required information because you as the employer, you had to provide your participants a notice or a statement that the plan provided minimum essential coverage and that it provided minimum value. So if the carrier didn't put that on your SBC, you were required to provide a separate notice to your participants. Now, there are only a couple other things that we want to go ahead and consider for a checklist. Did you give that exchange notice to all your new employees within 14 days of hire? Remember, that is still required. We talked about that Medicare Part D notice of credible coverage. If you gave it to your participants, did you then disclose to CMS within 60 days of the beginning of your plan year that your coverage was either credible or non-credible? That has to be done electronically with CMS. And then finally, we talk about imputed income. If you're providing any of your employees with group term life insurance that exceeds $50,000, anything over $50,000 is considered taxable income to them, and it has to be imputed and should be included on their W-2. So again, other things that we could have talked about, maybe some wellness programs, but just in the essence of time, we're going to go it short. But finally, as part of our checklist, the biggest question, did you put the JRG webinar series dates on your calendars? We did send that out several weeks ago. We have the first 4 already scheduled, so please get the dates on your calendar so you're aware of them. And before we open it up for questions, just another reminder. Give us your feedback. What do you like? What don't you like? What would you like to hear about? What's really important to you that we should be addressing? So send us an email on that. And with that, we'll go ahead and open it up for questions.
Okay, the first question. If you provide an opt-out payment for individuals to go onto another plan, not the exchange, is there a dollar amount limit before you may be penalized? And is this considered an ERISA covered plan and outlined in plan documents?
That is actually a great question, because with the opt-out payment, basically what the questionnaire means by an opt-out payment. So you have an employee who comes to you, and or you say the employee, maybe if you go on your spouse's plan, or if you're employed somewhere else and you have other coverage, I'm going to go ahead and give you money so you don't come on to our plan. That's considered a cash opt-out. First of all, the requirement is that any cash opt-out that's offered to an individual must be offered through a cafeteria plan. If it's not offered through a cafeteria plan as an option, then what you have done is you've opened up yourself and all the participants in the cafeteria plan to a tax liability. And that is because there is an old tax law, it's called the Doctrine of Constructive Receipt. And what it says is that we're taxed as if we received something, even if we didn't receive it. So bringing this back to the cash opt-out, employees who receive the health benefit actually should be taxed as if they received that cash that employees who get the cash opt-out receive. Again, kind of convoluted, but the way you get around that tax avoidance is to go ahead and put a provision in your cafeteria plan saying that employees have the right to opt out. As the requirement, are there any tax dollar limits? Actually, no. That's really up to the employer. The thing with the cash opt-out, you want to give enough incentive so they may move if they do have other coverage, but you don't want to make it so rich that it's going to bog you down financially. And then the second part of your question, is this considered an ERISA-covered plan and outlined in plan documents? Again, the cash opt-out, because you're offering people the benefits and then they're waiving it, you can put that in your plan document saying that people have the opportunity, but what you need to do, most importantly, is put the cash opt-out provision in your cafeteria plan document.
The next question, could you explain the accepted FSA plan again?
Okay, another good question. A health FSA is a group health plan, and it would be subject to the Affordable Care Act requirements. It has to cover preventive services and no lifetime or annual limits. Now, we know FSAs have limits. So in order for them not to be penalized or subject to the ACA, we say we have to make them accepted. And in order to be accepted, first of all, there is a requirement that you have to offer other group health plan coverage. I didn't mention that because everybody normally is doing that anyways. And then the other requirement, it says it's the availability of benefits, the maximum benefit that is available. The benefit the employee can receive from the health FSA cannot exceed more than 2 times the employee's salary reduction, or if greater, more than $500 of the employee's salary reduction. So the example, I'm your employee, and under the cafeteria plan, I elect $1,000 for my health FSA. And you come and you say, as part of our cafeteria plan, we not only match what you would put in your FSA, but we give you another $500. So when we look at the benefit that's going to be available to me, my $100 that I put in, and then the $1,500 the employer puts in. I only elected $1,000. I have available $2,500. That $2,500 is more than 2 times my salary election, so that FSA would not be accepted. It would not meet the requirements. As to the greater than the $500, again, let's say as an example, as an employer, you say to the employees, we are going to give you $510 if we're just going to give you $510 for your health FSA. And I, as an employee, say, $510 works for me. I'm not going to put any other money in the FSA. So my salary reduction election is 0. But the benefit I can receive is $510 in my example. $510 exceeds my salary reduction election by more than $500, so it wouldn't be accepted. So the word of caution, or the best business practice here, if you're going to give money as an employer to an employee's health FSA, never make it more than $500. But then you still have to be careful, because if someone doesn't elect it, you would be still within that $500 range. Just don't go over like the 501. I hope that answered your question. At this point, we don't have any other questions, but we will wait a minute or so to see if anything else comes in. And while we're waiting, again, we'll just go ahead and mention that for next year, we have our first 4 webinars already assigned. Our first webinar in January, we're going to be talking about the Medicare secondary payer rules, and it's called MSP rules. Can they stay or can they go? And hopefully that's an intriguing question for you, and you'll want to join that webinar. And it looks like we don't have any other questions at this time. So what we'll do is we will go ahead and, again, send out the PowerPoint to you, the recorded presentation, and I will go ahead and write up the answers to these 2 questions that were asked and make sure that you receive them. And with that being said, we want to go ahead and wish you the best of holiday seasons to you and yours, and hopefully we'll talk to you next year. Thanks so much for participating today.